Hi, it's Arjun. In last week's Super Spiked, a written post, we wrote about power being the third super cycle of our lifetime. And in this week's short video podcast, we wanted to share some thoughts on how the early days of the China-BRICs expansion from 20 plus years ago, how that compares and contrasts with the current AI-driven mania and its impact on power markets. Now, we are calling this series Then and Now, with the aim of trying to take the best lessons learned from that last super cycle and how we can be better prepared to navigate and hopefully do a better job of proactively addressing the current one. We have 5 points we want to make. The first and really overarching question is, will this AI-driven boom lead to an acceleration in global GDP? And when we think back to those China-BRICs expansion years, really one of the most important drivers is that global GDP, not just in China, but around the world, accelerated to above 3.5% and often above 4% global GDP. And that's versus the kind of post-2014 general global GDP deceleration and recent periods, kind of since 2019, where we've often been below 3% on global GDP. And it's, frankly, that sort of acceleration in global GDP is what a lot of analysts got most wrong about the China-BRICs expansion. The kind of multiplier effect, maybe an initially localized condition China expanding had on the rest of the world and what it meant for oil demand. And that ability to spill over into broader parts of the economy is really one of the, I think, potentially most important developments that we're going to be monitoring here. And today we're already seeing signs that here in 2025, energy usage in both China and the United States is doing better than feared. Now, make no mistake, that's not the same thing as saying booming demand is at hand, similar to 20 to 25 years ago. But we're doing better in both regions, and I think that bears watching. And this notion of a reacceleration in global GDP is really going to be one of the most important things we're going to be watching. It impacts more than just power. It impacts just about all commodities in general, including oil. Second key point, all commodity areas benefited from that China-BRICs expansion. So oil, most notably, as we've highlighted, but also natural gas, steel, coal, copper, a whole bunch of different metals and mining all did very well. Iron ore comes to mind during that China-BRICs expansion phase. And, it's our assessment that oil was the most important of the China-BRICs commodities, given its size and global criticality. This go round, we see oil as merely a beneficiary of this broader and frankly primary power supercycle. Oil, I don't think, is the driver this go round. And let us be clear, since some of you have been asking me, oil markets will benefit from general economic expansion. That first bullet point of, are we going to see some sort of better period for global GDP to come out of this power surge, if you will? You also have increased construction activity as all these different companies build out these data centers and so forth. We're not necessarily arguing for oil-fired power generation, though I do think to the extent you see brownouts or tight grids around the world, it will be interesting to see whether diesel-fired power generation has a little bit of a comeback a la 20 plus years ago. Third key point we want to make is the importance of whether it's analysts or companies modeling out what a super cycle really looks like in terms of revenues and earnings. And for winning sectors, whatever you deem them to be, whether it's different commodity areas, infrastructure, supply chain providers, whatever it may be, what does the full super cycle look like in terms of earnings, revenues, volume growth, and all of these kind of things? I'll use an example of oil from 25 years ago. Oil had been in a $20 band for a long time, and it kind of crept up to $30 to $40 a barrel. I believe myself and my team were the only ones who provided sensitivity analyses for what oil sector earnings would look like all the way up to and beyond $100 a barrel. And I can specifically remember one of the largest buy-side clients out there. He's someone who came from a competitor investment bank, went to this very large buy-side firm. And I always thought, oh boy, I don't know if I'm going to be able to win this guy over. And it was actually that analysis that did it, where he told me, Arjun, you're the only one providing these sensitivities, and it's very helpful. Most everyone else was just doing the normal plus or minus $5 or $10 a barrel, which frankly is, in a volatile sector like oil, is honestly a pretty useless kind of volatility analysis to do. We had the numbers going all the way up to kind of what we thought would be the full extent of the super cycle. And I think it did make a difference to our buy side clients at the time. And so for some of you, an oil price sensitivity may not mean much and it's not relevant to power sector. The idea is really don't anchor yourself to what the recent trends have been in revenue and earnings or the recent pre-super cycle past. That isn't what a super cycle is going to look like. That's sort of the whole point of it. It's not about placing 100% probability on some upside scenario. It's about understanding what it may look like and at least putting some probability that such a condition could come true. Fourth point we want to make is figure out what your signposts are going to be for a peak in the cycle and what's going to cause the cycle to peak and what's going to cause it to turn. In the China-BRICs area, we focused a lot on what is the oil price that's going to cause demand destruction. Our view was that OPEC spare capacity was limited, non-OPEC supply was going to lag, and oil prices would have to rise to a level that would crimp economic activity and cause demand destruction. And all the modeling work we did said it is not, some $10 a barrel higher or something like that. We're going to have to go to 105 was our number. We did it as a, gasoline spending as a percent of the economy. We did a bunch of work around that. And I think as far as trying to figure out a demand destruction oil price, that part of the call I think we'll declare was correct. And I feel like we did a good job on it. What I think we did not give adequate consideration to was separate from the oil price, what was going to cause energy equities, oil and gas equities, which was my primary responsibility, was to cover them. What was going to cause them to peak? And it actually wasn't the oil price. It was what we now know and we call the quadrilateral of death, which is that framework of oil prices relative to profitability. Initially, oil rose and profits went up. Then at some point, oil kept rising and profits didn't. And that should have been our warning that the cycle was over. And I've spent a lot of time in Super Spike talking about that. There is a question and we don't know the answer. I don't think it's a ROCE quadrilateral death framework that is going to be the signpost for the power sector in mass. Maybe some of the subsectors, but not the sector more broadly. I think we do need to figure out what are going to be the signposts. And again, there's sort of a pricing and a macro framework, but then there's a what drives equities framework. And those can be two different things. And again, that's one of our big lessons from the China-BRICs expansion. I think we got the oil price framework right. I think especially as someone who's always been a return on capital, I should have done a much better job on seeing those returns on capital roll over and not making excuses for why the numbers were quote unquote still good. I think the fifth and final area that frankly investors, but also companies have to come to some sort of thought process about is how do you want to navigate inevitable volatility? And do you want to try and be a short-term trader and adjust along the way? Or do you want to really think about the longer-term cycle? Clearly for corporates, there's usually going to be a focus on the longer-term cycle. And so the question becomes, as an investor, do you want to try and trade around things? I think a great example was the recent, for power specifically, was the recent DeepSeek scare from, I think it was December of this past year, where there was a question as to whether through the DeepSeek modeling, suddenly the whole power cycle and the AI cycle was over. And clearly with hindsight, that was a speed bump. There's a lot of good information to come out of that about where China was. And I think DeepSeek does represent the fact that China is going to be very much a part of this story going forward. That's going to be positive. It's positive for its energy usage and its economic outlook. But as far as being a sign of the peak, I mean, I think that's an example. How do you want to think through that kind of volatility? The stocks did get hit pretty hard. Some of you are really good at short-term trading. That does not describe yours truly. If you're good at short-term trading, how to have at it. My preference and style has always been, let's try and figure out these longer-term cycles. And so for us, what's most important is we believe we're in the early days of a power super cycle. We're going to try and understand its implications. And I think we're going to try and focus on what those endpoints are for both macro viewpoints, but also the sector and company and earnings and those kind of things. I think just maybe a final point for corporates. Investors, I don't know if it's a luxury or a curse, but investors can always sell a stock. They can sell a sector if things turn down. Hopefully they time it well. Sometimes you don't and all that kind of stuff. I think for a company, as one is thinking about investing in what might be a longer period here of better times for power-oriented themes, and again, it can be commodity sectors that feed into it, the supply chain, manufacturers of equipment, people who install this stuff, any number, generators, obviously. How do you think about beyond the super cycle? Because ultimately companies are going to need to have resilient businesses and be able to adapt for whenever that day comes that the super cycle rolls over. That may not be for 10 or 15 years from now. It could be from 5 years from now, but it's sometime well into the future. And I think how US E&Ps adapted or didn't adapt, as the case may be, is instructive. When oil fell from $100 a barrel in 2014 to $50 in 2015, there's no doubt when a super cycle is over, it's going to be painful for just about everyone in a given sector. But which companies on the margin either had better balance sheets or were able to more quickly adjust their cost structure and business models to the new environment? And we really had a much more divergent performance between, I'll say, those that either adapted well or were in a position to adapt well and those that didn't. Sometimes it's due to the asset choices you make. There are certain very long-lived assets, say in the oil business, that if suddenly shale is the dominant driver and shale is able to cut its costs, you might be stuck with assets that don't look as good at $50 that they did at 100, and there's nothing you can do about it. Where I contrast that with shale, initially shale did need a very high oil price, but it was an area where it was ramping up the learning curve. You had a lot of experimentation that went on. You had a lot of best practices that arose, and it came to be that you could have, it took some time, but you could have a much more profitable business at a lower price. So the choices one makes as a corporation for which kind of assets are going to endure when a super cycle inevitably ends is one of those key considerations as one thinks through both navigating volatility in the short term, but ultimately trying to live through whenever that 5 or 10 or 15-year period is where the super cycle does roll over. So I'll end this video on a personal note. And I will make a plea that I used to, it was a little bit of a speech I used to give to the analysts at Goldman about not being a consensus hugger. My comment was always be, we didn't need people within our research department who was plus or minus 3% of consensus. I could just look at FactSet or Bloomberg for that. You don't need to pay someone an analyst salary and bonus to get a consensus viewpoint. And the point isn't to be out of consensus just for the sake of it, but especially in these commodity and energy kind of businesses, there are really disparate outcomes, both on a short-term and a long-term basis. And I think this advice that I used to give to the analyst teams at Goldman Sachs or the people that work for me of don't be a consensus hugger, it applies to corporations as well. How does one stand out from the crowd? How can one lean in if they have a competitive advantage and to not just move with the pack? It's what most of Wall Street does, what most analysts do. And it is a plea to all of you out there who are investors, all of you out there who are analysts, but also to the corporations out there. Don't be a consensus hugger. No one needs to earn an above average income for just simply doing as well or as worse as everybody else. Thank you.